the topic for today is institutional DeFi, an area very close to what we do at Into the Block in our day-to-day. So we'll be talking first, doing a brief overview of the state of institutional DeFi, showcasing some very interesting data on how concentrated DeFi really is in institutional users, something that might not be as publicly well known. Then we dive into the key segments of users within DeFi and the drivers of growth for each, risks and considerations. So here we talk about the different layers of risks to consider, as well as capacity, which is one major factor we track very closely here at Interblock. And lastly, we wrap things up with the path ahead with an outlook on the space for the next few years. So before we get started, a quick update from our side here at Into the Block. We launched this very exciting feature we've been working for a few months now. It's called the ITV Risk Pulse. It's basically a feed that tracks all of the key activity across DeFi protocols. So for example, you'll be able to see all-time highs on activity on Aave, high-risk loan notifications, depegging events, a whole spectrum of activity. The product was launched yesterday and announced, I believe, yesterday as well. So you guys can encourage you to have a look. It's free to access, so take advantage of it. It's probably the most advanced platform consolidating activity across DeFi. So if you're interested in institutional DeFi, you'll most likely also enjoy this product. An example that we saw this morning, this is in the Spark protocol from Maker. The risk pulse notified that there was $100 million decrease in available liquidity, which we can see right here. And if you're deploying capital into this pool, you might be concerned that you might not be able to withdraw, or if you're a borrower, this might result in higher borrowing costs, so you could have to reassess your situation. So worth tracking. This is an example of what you can track. Our team just shared the link if you guys want to have a look. It's definitely worth diving deeper into. And we want to stress out it's a beta version, so there's a lot more coming soon. For example, we're working on API access. If you're interested, do contact us for this, so that you don't need to update the platform. Every time you're looking for the latest updates in DeFi, you can actually program things on your strategies based on our API, like rebalancing your position or moving assets from one position to another. Then we're also adding a whole scope of new indicators like large swaps, water whales buying, selling, the APYs for supply and borrow side. These are very relevant if you're looking to earn yield or if you're looking to borrow and optimize your borrow costs. Imbalances, so this can be a precursor to depegging events. So we're gonna be adding up that and a lot more. In the meantime, we encourage you guys to share some feedback if you want more metrics to see or any suggestions. Outside of our risk product, we also are launching today real world asset dashboard, which I'll talk about later. Of course, this space has been growing quite a bit, and it's very much in focus for institutions. So more on that later. Now let's get started. What is the state currently for institutions in DeFi? First question to address here is, is DeFi really mostly a retail phenomenon, or are institutions driving the main of the activity? As many of you will know, Aave is the largest DeFi protocol by assets, with about 30 billion in deployments. And you can see here that by the number of assets deployed on Aave on mainnet, most of them have 0 to 10K deposited. Only a few have over 50K. But when we look at the amount of assets, we see a completely different picture, where it's very clear that only a handful of addresses are deploying the vast majority of assets, as we can see here. So it's very highly concentrated. In fact, the top 100 depositors in Aave supply 85% of the full market. So basically the outside of the top 100, we see 15% in the assets being allocated. So this proves that it's very much institutional driven market. And it's not just Aave, we see the same pattern with Morpho, where liquidity is even more concentrated in the top 100 addresses that make up 94% of the supplied assets. Interestingly, we also find that you should not just care about institutions because they provide more capital. They're actually more active as well. So we see the same pattern between Aave and Morpho, where the average number of transactions becomes higher the more that you transact, the more volume that you transact. So it shows the pattern that retail and smaller users are more set and forget type of users that don't really rebalance their positions or might even like fully forget about their funds, whereas institutions are a lot more active, moving, rebalancing their positions here in DeFi protocols. Then it's not just the pattern with lending protocols. For example, Athena's SUSDE, the yield-bearing stablecoin. We can see here the distribution between the number of addresses. So it's not held by too many people, too many addresses, I believe like 10,000 holders. And most of the holders have only like 0 to 10 coins, probably just addresses that forgot those assets. And then if we look at the concentration by holdings, it's the complete opposite picture, where addresses between 100 million to a 1 billion plus hold the vast majority of the assets. I think it's like a $3 billion, $5 billion market cap asset. So most of it is just in addresses that hold over 100 million or at least 1 to 10 million, whereas those holding below 100K only make up a few million in comparison. So we see this picture of very high institutional concentration in Athena as well. And now to understand the drivers of growth, we really need to discuss who are the main players in DeFi. So given the magnitude that they're deploying, it's pretty clear that these are institutions or institutional sized whales. But they're split, I would split them into three main categories. The first one, which is the most active segment, is made up of market makers, funds, and family offices. So these are more yield chasing type of user, where they basically are looking to get returns on their capital and might be less aligned with the protocols long term. Therefore, the term mercenary capital has a rise to describe this group in conjunction, though of course every entity is slightly different. Then we have making the largest part of crypto native capital are centralized exchanges and custodians. So these basically aggregate capital within the user base and have like avenues to earn yield, where CeFi is basically like the front end for these users to access DeFi on the back end and get yield. And these are usually stickier since they have multiple components within them and might not be as mercenary as the former category. And lastly, below, we have, underneath the iceberg, the TradFi institutions, where we've seen some adoption, but really they're still pretty skeptical, though the things are turning in favor of TradFi starting to use DeFi rails more and more. And why would these institutions be using DeFi? Well, it goes back also to the purpose of each type of institution, but it's pretty clear that one of the main purposes is to earn yield. So you can earn yield not just on stablecoins, for example, where you can beat what you would get in money market funds or treasuries, but you can also earn yield on your Bitcoin, which is something you can't do natively just by holding Bitcoin or a Bitcoin ETF. So there are multiple ways that we discussed in previous webinars that you can earn yield on your Bitcoin through DeFi. Then, of course, you have increased transparency. You can track the chain as many do and encourage people to do. You can review like the deployers into a pool, check on Arkham, like what address is that tied to. You can even check if they're like on the list of sanctioned addresses. something that's a lot more difficult to do with TradFi rails. So your counterparty risk can therefore be reduced and actively monitored. And more importantly than anything, is DeFi is also used for fast, cheap, and global transactions. So you can make sure that you can send money from here to Venezuela, to Africa, anywhere in the world, and get that money arrive within. Like these days, you can get it to arrive within a second and for less than a cent, which is, orders of magnitude better than the current traditional finance rails that oftentimes would take 2 days, and worst case, like even a week for money to arrive internationally, and can charge $100 plus. So that's one of the main value adds of DeFi, and of course, stablecoins, which have a lot of connection with DeFi. In terms of the drivers for yields, one of the main factors that has been leading to more and more capital flowing into DeFi is the rise of new ecosystems. So already in 2020, 21, we're already getting pretty large investments on infrastructure that have continued into the current wave of crypto. So basically, DeFi TVL is downstream from these valuations. This is a pattern that might not be fully understood by most people, but basically, given that VCs are willing to invest on infrastructure in crypto at high valuations, and most of these, mainly L1s and L2s, or even the applications themselves, need liquidity to operate, they're willing to pay for large amounts of liquidity. And since it's a competitive environment with multiple players, this high demand for liquidity translates on larger incentives for liquidity providers. So therefore, the winners are ultimately some of the capital allocators that are, getting yield on their assets. And we see this pattern with chains like Bear Chain, Sui, Aptos, Ton, and the whole universe of L2s that has spun up over the last few years, with many attracting 6 billion plus, like we see with Bear Chain, with a matter of just a month or two. Then we also see inflows within crypto into DeFi due to new use cases that have been arising. So we have seen this cycle, the launch of restaking, pioneered originally by Eigenlayer, then Babylon and a few other players, where you get not just a staking yield on your asset, but also in the future have a layer of applications that pay for extra security that they would rather just outsource rather than having to launch their own chain. That is, you're already getting higher yields with restaking EtherFi ETH than Lido staked ETH. So that drives more capital on chain to DeFi. Then we're seeing strategies that were typically, relatively hard for your average user to do, that have been tokenized through DeFi rails and made accessible for a universe of new players. So Athena is a perfect example of this, where they conduct a carry trade, earn amount of money on that, and send the revenues to USDE holders, making this trade accessible. Resolve has a different take on this, but also very similar. And then we also see yield markets have gotten, became pretty relevant this cycle as speculation on these yields, and as yields become higher, people have opted to either take the yield up front to avoid risk. Is a very popular institutional use case, just to take the yield up front rather than having to speculate on points, or also for more retail or sophisticated players to bet on what those yields are, basically taking the over or the under on different sources of yields. We've also seen, and not as new of a use case, but we have seen a lot of growth within this, is real world assets. I do see a question, by the way. I'll get to that towards the end in about 10 minutes or so. So real world assets, of course, have been a major narrative for crypto over the last few years. We've been in the last 2 years from about 1 billion in TVL to over 10 billion today, hitting new all-time highs just this week. So part of the reason is we see T-bills providing the baseline for yields. So a lot of the previous like generation of DeFi before T-bills were integrated into DeFi, we at moments saw like T-bills be at 4 or 5% and DeFi yields on Aave be at like 1 or 2%, so super low. Now that those T-bills are supported, they sort of create a floor and make an easy avenue for people that don't want to have risk in the space to go from, you know, maybe instead of selling your ETH for stable coins, people are selling their ETH for RWAs. They're still selling their ETH somehow, as we can see in prices, but that's besides the point. And you can think of stable coins. Really, even though they're not considered within the RWA category by most data aggregators, they are really the original RWA product, since they're dollars that are tokenized in the banking system and provided on chain. Though the yield here is passed on to the underlying custodian, so Circle or Tether, instead of the user. And I think there are multiple signs that stocks might be next. You know, Coinbase is looking to tokenize coin stock, for example. And beyond that, there is a potential opportunity where, you know, there's a lot of people that want access to stocks that have dividends. For example, Microsoft, that has a decent dividend yield. Most retail doesn't really even care about the dividend yield. So there potentially could be a provider, you know, like Coinbase, tokenizing Microsoft stock, keeping the dividend yield for themselves, and instead making it free for anyone to trade these stocks on chain. So that's like similar, you know, access for stocks that are, you know, if you're in the emerging world, it's hard for you to get access to American stocks that have been outperforming historically. So this expansion to underserved markets is why tokenization and real world assets is likely to be continuing to grow over the next few years. Of course, with all of the opportunities, there are definitely risks that institutions can and must consider using DeFi. So I would place them within these three main categories. So first, you have technical risks, which are the most resounding ones. So you can see smart contract exploits. You know, Wormhole the Bridge lost about 300 million to this type of exploit, or even user interface redressing. So basically having like the UI show different numbers or different addresses than what you're thinking you should see. This is what happened recently with Bybit on Gnosis Safe. Though it's not DeFi, this type of attack has happened in DeFi multiple times. Then you have economic risks like manipulation of prices or oracles. Compound suffered one with oracles. Hyperliquid suffered another one just today by manipulating the price of a small meme coin. Then you see pool imbalances that can lead to like depegging events that can be seen for LPs in Curve. And of course, you have impermanent loss, which is a big consideration if you're providing liquidity to an automated market maker. Then on operational side, you need to make sure, like if you're a protocol, that you have a strong multi-sig setup, you know, not just like 2 out of 3 wallets controlled by a team operating the chain or the protocol, but rather a more distributed amount of addresses. And with the amount of users being spread out like globally, and also ideally having standalone devices just for signing transactions rather than, you know, having your personal email where you can be subject to a phishing attack on the same device that you control a multi-sig on. And lastly, with an operational risk, I would also include governance attacks. Polymarket also coincidentally had one of those today, as the Oracle providing the data for UMA was like modified through a governance attack. Then one positive aspect that we've seen for DeFi, and many of us at Into the Block were forecasting, is that DeFi losses have actually declined. It might not seem to be the case from what you hear in social media in your day-to-day, but it's been a very positive sign that the amount of losses in DeFi has been continuously declining. You know, not every quarter it's been declining. You know, we saw an increase in April 2022, and a slight increase in October 2024 relatively to Q3. Q1 seems to be pretty low in terms of DeFi losses, excluding Bybit, the Bybit hack that was 1.5 billion. But overall, it's a very positive sign that infrastructure has been getting battle tested and that builders are adopting best practices as those become clear, something that wasn't the case in 2020 when DeFi was just getting started. The other major consideration for institutions outside of risk and rewards is this extra variable that we like to call capacity. Basically, what that is how much you can deposit into DeFi, given that your risks are still attractive and you're not taking excessive risk. So it's downstream of the other two important variables. This is something that you need to consider in DeFi that you don't have to in traditional finance, because in traditional finance, treasuries, you can literally put 1 billion into treasuries and you would do very small impact on the T-bill rate. And it's also like the risk-free alternative. So therefore, even if you slightly affect the rate, you're still earning the best risk-adjusted reward, or at least the lowest risk reward. So by the definition, there's not much of a constraint on capacity on treasuries. Then for DeFi, you have the opportunity to beat treasuries in multiple options. And by definition, it'll be riskier than the risk-free treasuries. So institutions should seek to get, usually at least, a few basis points higher than traditional finance, but more typically at least twice is what we see from our audience. And then this capacity can be affected given a function of liquidity, market inefficiencies, and risk constraints. And it can be boosted inorganically through incentive programs. Larger pools, that shouldn't come as a surprise, have more capacity. So for example, on Bear Chain, there's a few pools in the hundreds of millions of TVL that you can put in 1 million in liquidity and it would have very little impact on the rates remaining above the treasury rates. And it's also a signal of lower risk as there's more TVL, should indicate that there is more institutional approval and less risk for them. Then it's also a function of like the distribution of assets in a pool, for example. So for stable swap pools like a Curve, if you're in a pool where the pool is very imbalanced or highly concentrated, you can see that your exit fee withdrawing up from a pool can go up quite dramatically depending on those variables. So it's worth monitoring what capacity of the pool you can take given those factors. Usually, as a rule of thumb, 10% of a pool tends to be fine. But given like the conditions of the balance of a pool and others, it can be leading to different constraints. Now, finally, let's discuss the path ahead for institutional DeFi. I would narrow it down into three main factors of why DeFi is leading to become not just like for crypto native institutions, but also for traditional finance to embrace it. We're still in stage one, which is the tokenization of existing assets. So mainly this has been T-bills accessible through DeFi rails. What that means is, okay, maybe instead of holding just regular dollars that don't earn anything, you can quickly go from Bitcoin or ETH, whatever asset, to T-bills so that your assets are never idle. It's worth stating that, there's a lot of money in checking accounts that is not earning any yield. So making like the savings yield easily accessible and just by itself is an order of magnitude of capital that can come in. And hence why we're seeing about $10 billion in this space. But moreover, we're expanding to more assets coming into DeFi and broader integrations into DeFi protocols. So the next step, as I mentioned, is likely going to be tokenized stocks. There's some demand for this, particularly outside of the United States, where you get easy access through Robinhood or some brokerages into stocks, but that's not the case in the emerging world. So being able to invest in stocks globally is a huge expansion for the market size that crypto can attract. and also be able to do like financing against them. So one of the advantages of DeFi is that it's permissionless. So imagine in the near future, you will be able to put your Tesla stock and borrow against it on chain without having to get any extra permissions. It's basically just making sure you have enough collateral. It comes with, of course, associated risks, but it expands the universe of people that can borrow against equities as well. And lastly, I think probably towards the second, well, we're already in the second half of the decade, but towards the finish of, late 2020s, we expect more novel use cases that are like crypto first to rise. So one example I've thought about before is microcredits have typically been very regional. So there's like a small universe of people that are willing to take the risk of making small loans to underserved communities. Now with DeFi and being able to transfer money globally, you can see a risky universe where some people might be willing to do some loans across the globe and get paid higher than average returns, though of course with higher risk, as I alluded to. There's a lot of pending items to be, configured for this to work, but I think we're leaning in that direction. And then we also see the rise of AI in parallel, where agents are already starting to manage capital. So there could be agents, instead of loaning capital to a person, there might be loans to agents, either to do like execute a strategy just in time or like more discretionary trading. And there could also be agent to agent financing, where like one agent deems that it's a good source of yield to loan to another agent. So this will, really make things pretty crazy, and in a way that the traditional finance rails are not really equipped to handle. So within these three, I think we're expected to see another order of magnitude of inflows into DeFi. And to wrap things up, I would say DeFi is already institutional. Like over 90% of the TVL in most protocols comes from just a handful of addresses, which are at the moment mostly crypto native. Slowly but surely, we're seeing TradFi embrace DeFi, and that trend is likely to continue. Growth has been coming mainly from high yields, which it's okay. It's natural for people to lure people into the system. But then also by the virtue of having a more efficient system that's lower cost and faster settlement. There are, of course, unique risks to consider with DeFi. So this is why it takes time for institutions in the traditional finance world to adopt DeFi, but they're getting educated. We're seeing promising signs, and we're heading towards a sea of opportunities for the years to come. Thanks, everyone, for tuning in. Make sure to sign up for the next webinar. We'll be diving deeper into risks. As a DeFi trader, our CEO, Jesus, will be taking this one, diving into our new risk pulse product, but also giving a broader approach, a broader analysis on what risks DeFi traders should consider. So thanks, everyone, again. I'll be sticking around for questions. See a few ones already. Give me a few seconds and I'll be getting to them. Okay. So Isa is asking, what makes Aave popular, attractive for DeFi assets compared to other protocols? Yeah, the main reason why Aave is probably the most, let me get to this slide, the most institutional friendly DeFi protocol is its liquidity. So especially with lending protocols, liquidity begets liquidity, as the old adage goes. So basically, if you're looking to borrow $10 million, which is the sizes that a lot of these institutions handle at a minimum, and you try to do that in a small lending protocol that just launched, especially in smaller chains, by trying to borrow that amount of capital, you would most likely, take all of the available liquidity, and that leads to your borrow costs spiking quite dramatically. Whereas in Aave, that has 30 billion in assets, you can do multi-million-dollar loans and have very small impact in your rates. So that makes Aave more predictable. And then two, the liquidity is also a sign of lower risk because it has been able to attract that over time. In the case of Aave, it's been operational for several years without any major exploits as well. So that makes it, very competitive from the risk perspective, while also having a lot of capacity to scale into the protocol. Then Jorge is asking, what about real estate assets? Are they ready for DeFi? Yeah, that's a good question. And I've thought about this to a certain extent. There are several reasons why stocks are a lower hanging fruit than real estate. Main reason is real estate is very regulated and also less accessible than stocks. So real estate, of course, like your average real estate transaction is in the hundreds of thousands, if not millions, whereas stocks can handle smaller transactions. So your underserved market, like think about like the emerging world, is not really looking to invest in scale in real estate in the US. They're more looking for higher return, smaller cost items. So stocks are an easier pick for that. And then two, the tokenization of real estate also comes with the concerns that it's not as differentiated as just regular real estate investing. There is some reasons like the some arguments for tokenization and like micro ownership of real estate, and why I think that has merits long term. It also creates other regulatory challenges. So basically, this we saw a microcosm of this with NFTs. Just a regular NFT is considered like a collectible or an art, but when you tokenize one NFT into multiple versions of it, into smaller pieces of it, it's more akin to a security. So therefore, you need all the security compliance parameters. That makes it very hard for real estate issuers to be comfortable tokenizing tokenizing real estate. Instead, asset issuers might be more comfortable, and like the exchanges embracing tokenization. And I think the fact that Coinbase and more recently Crypto.com also aligned stock tokenization efforts, it's pretty clear that that's going to be the next stage. And real estate is probably going to have to wait a few more years to scale. I'll wait a few more seconds to see if we have any further questions. If not, we can wrap things up. I see a few things. I appreciate you guys tuning in. I think we're gonna wrap things up there. Thanks, everyone. Hope you have a good day, and we'll see you in the next one. See ya.